All right, so let's get started with capital ratios and liquidity ratios. These are some of the last topics for financial markets before we head back to our corporate finance.
Hi everybody, in this video we're going to look at all the different types of limits on bank lending as a form of regulation to protect against bank failure, to protect against systemic risk, full financial sector collapse that is. In this video what we're going to do, we're going to look at all the different ratios available, for example, all the different requirements available, for example, to limit bank lending, to protect against bank failure and systemic risk. We're going to look at the ratio, the equation, for example, how to interpret the figure, what kind of regulation can be imposed, the intention of the regulation, but also we're going to look at Basel recommendations. You need to know a little bit about the Basel Agreement. The Basel Agreement are just rules, they're regulations, they're limits on bank lending, regulatory frameworks basically, to help prevent something like the 2008 financial crisis happening again. So they are recommendations decided by industry experts who met in Basel, who formed this committee, to help prevent something like 2008 happening again. And a lot of their recommendations were over things like capital ratios, liquidity ratios, leverage ratios, for example. We're going to look at those, exactly what those recommendations are. Now, they are only recommendations because the Basel Committee themselves, these experts themselves, do not have any international power to enforce these regulations on countries around the world. No, they are just voluntary recommendations. So it's up to international governments themselves whether they want to enforce them. What you need to know is that the European Union, for example, have decided to take those recommendations and actually enforce them as financial market law, as actual regulation. For example, the PRA in the UK must monitor whether these regulations are actually being met or not. So they have actually been enacted as EU law. The UK, for example, will follow them. So yes, they're only recommendations, but now you know that they are part of EU law, thus they're part of UK law, whilst we remain part of the European Union. So any kind of recommendations that apply for these ratios or requirements I will talk about as well. Let's get started by looking at the cash ratio. Here is the equation for the cash ratio. We divide cash assets as part of the balance sheet by current liabilities. Remember, current liabilities are short-term liabilities, your deposits, your short-run borrowing in the balance sheet of a commercial bank. So I've written a little mock balance sheet here, just isolating the two parts that would actually be considered in this equation. So the two assets, which count as cash assets, or cash themselves, and also reserves at the Bank of England. You've also got liabilities here, short-term liabilities of deposits and short-run borrowing. So what we do, we divide our cash assets at £20 million by our current liabilities, £100 million, and that gives us the cash ratio. In this case, we've got 0.2 or 20%. So what this tells you is, for every pound worth of liabilities that you have to pay, how much cash do you actually have? So for every pound of liabilities that this commercial bank owes, they've got 20 pence worth of cash assets to pay that off. So the regulation would be to maybe impose a cash ratio if one doesn't exist already, or to raise it if it does. The intention of doing this is to prevent a liquidity crisis, to make sure that a bank will always have enough cash, basically, to pay any short-term liabilities that it owes. So if 20%, for example, is deemed not good enough, maybe they can raise it to 30%, whereby a bank must keep more cash assets to pay its short-term liabilities to prevent a run on the bank, to prevent liquidity crisis, and therefore to prevent bank failure and reduce the chance of systemic risk. The Basel recommendation over cash ratios, none apply. Basel recommendations are over liquidity ratios, capital ratios, and leverage ratios. Let's now have a look at liquidity ratios. So let's look at a liquidity ratio here. Here is the equation to work out a liquidity ratio. You've got your current assets, divide those by your current liabilities, that is your short-term assets, divided by your short-term liabilities. There are four assets that count as short-term assets, i.e. current assets: cash, reserves at the Bank of England, money on short notice, so that's any interbank lending, and any short-term investments as well. So they're the four short-term, highly liquid current assets, and they're your two standard short-term liabilities. So if we take our numbers here, you've got £80 million worth of current assets, you've got £100 million of short-term liabilities, current liabilities, and that will give you a liquidity ratio of 0.8 or 80%. So what could the regulation be here? Well, maybe to impose a liquidity ratio if it doesn't exist already, or to raise it. What is the intention of that? Well, again, is to prevent a liquidity crisis. So this is a little bit more developed than the cash ratio. whereby you can have slightly less liquid assets included as well, so money at short notice and short-term investments, whereas the cash ratio was just your immediate cash assets. But the idea is that these are still very highly liquid, so in case you need to pay back any of your short-term liabilities, you will have enough liquid assets to pay it back. That's the intention, to make sure the bank has got enough liquidity to pay back any short-term liabilities, to prevent the risk of a bank run, to prevent the risk of a liquidity crisis. That's the idea.
Do you think strength is a gift? It's not.
So maybe if, let's say, that the PRA, the Prudential Regulation Authority, let's say, or even the Basel Committee decide that maybe 80% is not good enough, they can raise it to 90% or even to 100%, whereby more liquid assets need to be held, just in case short-term liabilities need to be paid immediately. What about the Basel recommendation? There is a Basel recommendation over liquidity ratios, and these are important to know. Over basic liquidity ratios, this is what was agreed. So from the 1st of January 2015, commercial banks would need to hold at least 60% liquid assets, short-term assets, current assets, to meet their short-term liabilities, with the intention of raising that figure by 10% each year to January 2019, when that figure would become 100%. But there is also this liquidity coverage ratio. This one is really getting the headlines, whereby commercial banks need to have full coverage, so 100% liquidity, to cover any liabilities or short-term liabilities that are owed in 30 days or less. So any immediate liabilities that are owed that need to be paid in 30 days or less, in this case, you've got 100% liquidity to cover that. That is a recommendation of Basel. That's a liquidity coverage ratio that is now enacted in EU law and now in UK law as well. So good to know that. That will really help you get top marks in your essays if you're able to quote that. Let's now move on from liquidity ratios and look at reserve requirements. So the reserve requirement. The reserve requirement is simply the fraction of deposits that must be held at the Bank of England. So when deposits are put into a commercial bank, how much must be kept at the Bank of England, and therefore how much can actually then be loaned on to individuals and thus spread around the economy. Well, let's say it's set at 10%, so that is the reserve requirement. It means that if £100 million worth of deposits are put in a commercial bank, then 10% at least must be kept as reserves at the Bank of England. So that's at least £10 million. This will meet the reserve requirement there. So the regulation could be to impose it. There isn't this regulation at the moment in the UK. It's deemed to be quite restrictive over bank lending and restrictive over bank activity. So it doesn't yet exist. So maybe to impose it, if it does exist, to raise it. So if we're not happy with 10%, make it 20%, whereby £20 million at least must be kept at the Bank of England if £100 million worth of deposits are put into the commercial bank. And the intention again is for liquidity, to make sure that the bank has got enough liquidity in case depositors come back and want their money back, in case there are any short-term lenders to the commercial bank that want their money back. So the idea is to prevent or to reduce the risk of a liquidity crisis, of a bank run, and thus a bank failure in that sense. There is no Basel recommendation here at all over reserve requirements. However, in the USA, the Federal Reserve have imposed a 10% reserve requirement. The Federal Reserve have got the power to change that. They're in control over this reserve requirement, to increase that, to decrease that, whatever they want to do, even to scrap it completely. They have got the complete control over the reserve requirement. It's a bit more complex in the USA, but for banks of a certain size, it stands at 10%. So we've seen three different types of limits over bank lending there to help reduce the chance of a liquidity crisis and therefore a run on the bank. We're now going to look at two different ratios that can help reduce the risk of insolvency and thus a bank failure in that regard. Let's start by looking at the capital to loans ratio. The capital ratio, here is the equation for the capital ratio. You've got the total level of capital divided by the loans issued by a commercial bank. So if we take this look at the balance sheet here, magnifying in, focusing in on just the core parts of a balance sheet that we need and the figures that I've given here, you'll see we've got £15 million worth of capital and £100 million worth of loans. Loans, remember, are advances on the balance sheet. So £50 million divided by £100 million worth of loans gives you 0.15 or 15%. What does that mean? That means that for every pound that is issued as a loan by the commercial bank, they've got 15 pence worth of capital there. So you can see this ratio is very important to see the health of a commercial bank in terms of how much capital they have to offset any potential losses in loans. Now bear in mind that not all loans issued are going to be really risky are going to be really dodgy, are going to be at risk of going bad. So it's not like you need this to be 100% or close to 100%, because a lot of the loans that a commercial bank issues will be absolutely fine. So bear that in mind as well. And also bear in mind here, it can be specified which loans are included in this capital to loans ratio. We'll come back to that in a second. So what regulation can be used? Well, we can impose a capital ratio, or we can raise the capital ratio. If you raise the capital ratio, what does that mean? Well, from 15 to 20%, it means that more capital will need to be held by the commercial bank to protect against any potential losses in loan value. So if we raise from 15% to 20%, this bank's got to make sure that they've got at least £20 million worth of capital to offset any potential losses in loans. So imposing it or raising it. The intention is very simple, clearly, to protect against insolvency, right? Whereby a bank doesn't have enough capital to offset the value of any losses in loans. So therefore, to protect against that type of bank failure and potential systemic risk as a result of that. Is there any Basel recommendation? Yes, there is. There is an 8% minimum capital to loans ratio that they recommend. Now, the problem with the capital to loans ratio, which is why it's kind of lost favour as a means of financial market regulation, is because of this. It's possible to specify which loans are included and which ones aren't. The problem with the capital ratio, which was used between 2010 and 2012, is that the ratio specified that things like mortgages and other more safe loans would not be included in the capital to loans ratio. The loans that would be included are only the really risky ones. So for example, loans to firms, loans to entrepreneurs. Loans that are deemed more risky, only those would be included in the capital to loans ratio. But the problem then is that you have many commercial banks who are singing their praises, meeting their capital ratio requirement, for example.
Turn your ideas into videos. Go to artlist.io and get everything you need.
But if their mortgage loans go bad, or their more safer loans go bad, outside of mortgages, they might still get into lots of trouble. So just because you're meeting your capital to loans ratio, if that ratio doesn't actually take into consideration mortgages and other loans which could go bad, then you're not necessarily in a safe position. That's why the capital to loans ratio now is not necessarily the most used financial market regulation that we see. What's more in favour is the leverage ratio, which is much more comprehensive. So therefore now let's move into the leverage ratio, which is what the Basel Committee favour much more now as opposed to the capital ratio, and understand why that's better. The leverage ratio is more comprehensive than the capital ratio. If we look at the equation, we see why. It basically tells us how much the commercial bank is leveraging their capital when it comes to loans and long-term investments that they issue. So it takes capital and divides that by the total loans and long-term investments that a commercial bank has on its balance sheet. All loans, crucially, in the leverage ratio here. You see the difference between this and the capital ratio, but also long-term investments. So if we look at our balance sheet here, we've got £15 million worth of capital there, and we've got £120 million of loans and long-term investments right now. Crucially, it's all loans that will be considered here. So we take £50 million and we divide by £120 million, we get a figure of 0.125, or 12.5% leverage ratio here. And that means that for every £1 that the commercial bank has as an asset in terms of advances or long-term investments, they've got 12.5 pence worth of capital there. That's what it means. So again, this is a very important ratio to help to guard against insolvency. What's the regulation that can be used? Well, to impose it, to make sure that a commercial bank has got enough capital to offset any losses in long-term investments and in advances, i.e. loans. The intention is to prevent against insolvency, very much to protect against insolvency, to make sure that if any loans or any long-term investments go bad, the commercial bank will always have enough capital to offset those losses there. And again, remember what I said in my last video. It's unlikely that all long-term investments or all loans issued are going to go bad. So this ratio does not need to be set too highly, because you would hope that the commercial bank is not making too many risky loans. It's not holding too many risky long-term investments here, whereby they would need to hold huge levels of capital to offset any potential losses in loans and long-term investments. So the number, if it's set lower, is not necessarily a problem. But the idea is to protect against insolvency, to protect against that type of bank failure and the systemic risk. So the regulation could be to impose it, or in fact to raise it. So if they feel like, in this case, 12.5% is too low, regulators, they can raise that to maybe 15%, 20%, whatever they feel is necessary to make sure that the commercial bank is holding enough capital to protect against insolvency. What's the Basel recommendation? Well, the Basel Committee like leverage ratios because it's more comprehensive, it's more conclusive really, it's a better safeguard against bank failure. And they say that a minimum requirement of 3% is adequate. Okay, so that is the Basel recommendation there for you. The leverage ratio, the reason why it's preferred over the capital to loans ratio or the capital ratio is because it is more conclusive. All loans will be taken into account, not just the risky loans like the capital ratio will include, for example, but also long-term investments. If we generalize this, guys, which we can, and we look at capital divided by total assets, again, it can be very comprehensive, this leverage ratio. So that's why the Basel Committee like it. That's why they use it now as their primary mode of financial market regulation, alongside the liquidity ratios that we talked about before. That way, any runs on the bank, protected against, liquidity crisis therefore protected against, and any risks of insolvency will be protected against as well. So that covers all the different limits over bank lending. Very simple when you get your head around it, and very logical when you understand it. Great to use in your essays alongside this incredible A-star type application here as well. Stay tuned for the next very, very important video when we criticize, we look at cons of financial market regulation and also evaluation points. Lots to talk about there. I'll see you all in that video.
And we're going to do that right away.
Hi everybody, let's in this video look at the problems and the evaluation points to financial market regulation. This will wrap up the series of financial market regulation videos in this playlist.
This is the
Let's
last
get
one,
straight
guys.
in by looking
for
at
this.
moral hazard. Remember the types of intervention such as liquidity assurance by the central bank, by the Bank of England, but also potential bank bailouts if systemic risk is a real issue. Well, these kinds of interventions can promote moral hazard, where the cost of a bad decision is borne by a third party. And if you have these interventions, such as liquidity assurance, emergency liquidity, for example, such as bank bailouts, you create bad incentives for commercial bankers. Commercial bankers will take on more risk, excessive risk, knowing that if those risks go bad, it's going to be a third party, maybe the Bank of England, maybe the taxpayer, that has to bail these banks out, that has to bear the risk of that bad decision, right? And therefore you incentivize more and more and more risky decisions, bad decisions, decisions against the interest of society taking place, given that a third party is going to bear the cost of that bad decision. That's the idea of moral hazard. You promote that if intervention, if regulation is excessive.
Here's a brand new, better way to sell your house. So if you're thinking about selling anywhere in or around the Grand Rapids,
In those two ways that I mentioned. You've also got the problem of regulatory capture. This is where regulators form very close relationships with managers and CEOs within the financial sector and are therefore lax with regulation because the people that they know influence the regulator. And this is quite likely to happen, you can think, because the best regulators are often the ones who have previously worked within the financial industry. They're the ones that understand banking very well. They're the ones that can decompose balance sheets and decide the best regulation to reduce the chance of bank failure and systemic risk. But always, as a result of that, the chance for CEOs and managers to form very close alliances with these regulators is much greater and influence the regulator to make regulation more lax, which might not be in the interest of society. That's known as regulatory capture. Link that to the costs of regulation. We could have significant government failure here, where the costs of intervention outweigh the benefits, especially if regulatory capture means we don't get many benefits at all from financial market regulation. You can always be concerned about asymmetric information. Now, we talked in my previous video of types of regulation about all the limits on bank lending as an example. Yeah, but there is always asymmetric information. Who's got the information? Banks have the information, right? Regulators want that information as much as possible so they can impose good capital ratios, liquidity ratios, leverage ratios, for example, reserve requirements maybe. But if banks hide that information, it makes it much more difficult for regulators to impose the correct, strict regulation necessary to protect against bank failure and systemic risk there. So asymmetric information makes it very difficult to regulate effectively. You've also got information failure that exists within the financial sector. This, we can argue in a different way to asymmetric information. Let's take the type of intervention which maybe bans the mis-selling of products or bans financial products that are against the interests of consumers. Well, that's all well and good if you do that, but what regulators don't know is what the next product commercial banks are working on or investment banks are working on. They don't know that information. Banks are, of course, going to keep that to themselves. And that information failure means that maybe regulators are always one step behind the game when they're regulating, given that bankers are always one step ahead and are trying to look at new risky products that they want to sell to consumers and earn high profits from, for example. So the banning of selling products is never necessarily going to be perfect. We can also look at the unintended consequences of regulation. Let's take different examples. Let's take deregulation. Well, what are you deregulating? Are you deregulating, separating commercial banks from investment banks? Well, that could be quite dangerous, for example. Are you deregulating things like reserve requirements, capital ratios, liquidity ratios? That could be quite dangerous as well. If you deregulate to promote competition, does that mean that potentially there might be monopoly power because incumbent firms maybe can gain strength and increase their barriers to entry and create monopoly in the financial sector? So you've got to be careful over the impacts of deregulation here. You've also got to look out for the unintended consequences of over-strict regulation, such as limits on bank lending. What you might do is if you make commercial banking very kind of unprofitable and not worth doing, you promote these bankers to actually move into the shadow banking industry instead, where there isn't as much regulation that's imposed. For example, moving into hedge funds, moving into mutual funds, where huge profits can be made and less regulation, maybe even no regulation at all, because those kind of industries are not dealing with consumers, they're dealing with large-scale investors instead, and therefore you don't see as much regulation in those areas. But that means that actually there'll be less commercial banking taking place, maybe less competition within the commercial banking industry, not in the interest of society at all. So you've got to look out for the unintended consequences in that sense of over-strict limits on bank lending, for example. Even deeper than that, firms may shut down, so commercial banks may shut down, they may leave the country, they may go elsewhere. That's not the intention of regulation, and that's what could happen if you're too strict with limits on lending, for example, with your ratios, with your reserve requirements, for example. Another issue is maximum interest rates and the unintended consequences of maximum interest rates. We know from our basic economic understanding of price controls that if you set a maximum price, i.e. a maximum interest rate, there is going to be an excess demand in the market, right? That's inefficient. You're also encouraging bad borrowers to come into the market. Not a good idea. And you're also discouraging lending, and that could harm economic activity. That could hold back economic growth, couldn't it? Right? And that could reduce incomes in the economy, reduce growth rates in the economy. As a result of that, that's not the intention. So this is all what can happen if regulation has not been thought about carefully. You get these unintended side effects. And also, the administration and the enforcement costs of regulation as we're used to. These regulatory bodies, these regulatory organizations that we understand are very costly to maintain. And linked that to regulatory capture, as we said before, if there isn't much benefit that comes from regulation, then the cost could well exceed the benefits and we get government failure here. So evaluation points to consider when you're writing an essay here, or just to think about when you're considering the impact of financial market regulation. Well, the first one is so important. A balance is needed, very much needed, to protect consumers, yes. To protect against systemic risk, yes, but not to kill the profitability of commercial banks. We don't want to ruin the idea of actually running a commercial bank, right? What's the point in doing that? You want commercial banks still to be profitable, still to run, still for there to be an incentive for them to run. But if you regulate too strongly and you decimate the profitability of commercial banking, then that is something you definitely do not want to do. So you want to protect consumers, you want to protect against systemic risk, yes, but you don't want to decimate profitability of commercial banks at all. Otherwise, you don't get many commercial banks that exist. There is a risk of oligopoly or monopoly kind of outcomes. Collusive outcomes may be the end result as well. If you take away competition from the industry because you're too tight on the regulation that you impose. So you don't want to harm bank profitability. You still want banks to exist and to make decent profits. You still want the incentives for potential commercial banks to enter the market and then to be competitive. Very important point there. You also want to make sure that regulation promotes equity, yeah, so fair outcomes for consumers, outcomes that protect the public interest, yes, but without damaging efficiency. This is a big argument here. And if you take maximum interest rates, for example, as a type of regulation, it's pretty clear to see that efficiency is going to be harmed drastically, isn't it? There is going to be an excess demand out there, inefficient outcomes. We have a shortage of lending taking place, not in the interests of society, of consumers here at all. You also have got the problems of a lack of innovation that can take place if you have maximum interest rates, for example. A lack of competition, because why would firms want to enter if they can't charge interest rates beyond a certain level, right? If you set lending restraints, for example, that are very, very strict, that can harm efficiency as well. If there is less lending that takes place because of the tight ratios and reserve requirements you put in place, that can harm efficiency with less lending taking place in the economy. That's not what you want to do. You don't want to promote equity whilst damaging efficiency. So look out for that as a strong evaluation point. And also you can weigh up the costs versus the benefits of the policy. So if we argue that the costs maybe outweigh the benefits, there is rationale for this regulation not to take place at all. However, if you argue the benefits exceed the costs, then fine. And the benefits in this case is to protect the public interest, to protect against systemic risk, to make sure there is no financial system collapse whatsoever, which does not just harm those who work in the industry and the institutions themselves, i.e. commercial banks, but it will create ripple effects throughout the economy. It will harm individuals who lost income, for example, through unemployment, for example. So if you argue that the benefits of regulation in protecting against that outweighs the significant costs of these regulation authorities, then fine, there is a rationale for regulation. But if it's vice versa, then maybe not. There is more a chance of government failure here. So that covers the problems and the evaluation points of financial market regulation. Make sure you use them and you develop these ideas in real detail, and you'll score big marks when you're writing essays. And your understanding generally of financial market regulation will be much, much better. So thank you so much for watching, guys. I'll see you all in the next video.
Actually, he won't, because that is the end of financial market aside that we did. Starting next session, we are going to go back to Dr. Derek's presentations and head right back into corporate finance now that we understand how the market works.